good morning, traders. And today I really want to focus on what's happening in some of these Chinese markets, Chinese assets at the moment, because I think they are in a very interesting spot. Of course, they have been significantly underperforming if we look at Chinese equities for quite some time. And that obviously is a reflection that people are moving money out of China because people do see them coming off second best in this trade tension with the US. Certainly, we've seen US assets doing very well. And as we go into the back end of the week, we are looking at that US earnings season where, again, earnings are expected to be very, very good indeed. The market's looking for about 21% EPS growth. They're looking for about 11% revenue growth. And the S&P, while we have seen some deterioration in price of late, is still holding in fairly well, but it's China that's really underperforming. And certainly it's not just the equity story. And the failure yesterday to really propel and have sentiment boosted by the PBOC cutting reserve ratio requirements for some of the big banks by 100 basis points. Okay, that is offsetting some of the liquidity drain that's going to be coming from some of these tax initiatives that have been playing through. And also we've got a maturing medium lending facility due very soon as well. So that is going to address some of those liquidity issues there. But there will be a capital injection into the banking system as well. I think the timing obviously was designed here to boost sentiment before the reopening of the market. And of course that didn't happen. The Chinese markets, the onshore markets, the CSI 300 had a 3 Z-score move yesterday, which is statistically very significant. But it was playing catch up because it was closed last week. And Hang Seng, the H shares, looking pretty weak at the moment. In fact, the Hang Seng had a bearish outside day reversal and is actually trading at the lowest levels for quite some time. It's in free fall at the moment. You've got a lot of air pocket in terms of those technicals at the moment. So short positions clearly favoured in terms of a risk reward. What is going to happen to change that trend that we're seeing in the H shares and the Hang Seng? It's going to, when we've seen a liquidity injection through a cut in reserve ratio requirements, but the market fails to respond positively. Everyone was selling the open. That's a big thing to be considering as well. We are very much focused on what's happening in the US dollar against the CNY, the onshore Chinese renminbi, and also the CNH, which is the offshore Chinese currency traded out of Hong Kong. And specifically for us, we offer US dollar CNH as a tradable product, and that's the one we want to focus on at the moment because it is pushing quite convincingly north of 6.9, which is the line in the sand, and everyone is asking whether or not we can push up into 7, which would have big implications for financial markets. Of course, the Australian dollar has a strong inverse correlation. When you see US dollar, the CNH weaken, the Chinese renminbi weaken, you are seeing a weakening effect coming through in the Australian dollar. Of course, a lot of the goods that we do produce here in Australia are priced in US dollars. So when you see the yuan weaken, the price of those goods in Australia is becoming more expensive. The importers are losing purchasing power in China, and that's not good considering that 35% of our exports do go to China. So we are a leveraged play. We are the G10 proxy of what's been happening in those Chinese markets at the moment. If the US dollar continues to appreciate relative to the renminbi, then of course you are going to see the Australian dollar continue trading lower. And I think that's a big impact because people in China want to see a stable currency. It's in their interests to believe in the Chinese renminbi, to believe that it has a store of value. And if it continues to weaken, that will have big impacts for people. You will see a situation where more and more people try and get money out of China, try and get themselves into US assets, try and get themselves into foreign assets. And those capital outflows will represent a tightening of financial conditions in China. And we've seen the PBOC and the state-owned foreign exchange department talking about trying to keep a stable renminbi and really targeting those capital outflows as well. And one thing that we are focused on coming through in mid-October is the US Treasury's report on whether the Chinese are a currency manipulator. Now, there are 3 really key questions that they need to look at. One is the level of bilateral trade surplus with the US, and that needs to be above 20 billion. At the moment, the trade surplus that China runs with the US is around 375 billion. So that is absolutely massive, and that's obviously something that Trump and Mike Pence and the US Treasury on the trade representative team have been focused on very closely. That's more than double pretty much every other nation's trade with the US put together. So of course that is the one part of the currency manipulation story that the US is very, very focused on. The next question is do they have a current account surplus, a material current account surplus, and that material level is about 3%. Now China's current account is around about 1.5%. And if you look at some of the factors such as the IMF's forecasts on Chinese current account, that is expected to fall over the coming years. So of course, in that question, you cannot really class China as a currency manipulator. And then the third question that the US Treasury will be asking is there one way input to stem the moves in the currency? And I think everything that we have seen from the Chinese of late has been to actually strengthen the currency, not weaken the currency. And that's obviously a very interesting situation, that they haven't really been using their FX reserves and the powers that they have to try and move and manipulate the currency. They can use FX reserves to try and weaken foreign currencies and strengthen theirs. But the idea here is that they are actually looking to strengthen their currency. They're not trying to weaken their currency. So the three questions that the US Treasury Department do ask, two of them you cannot categorically say China is a manipulator. So I think China will be very, very aggrieved that they are labelled a currency manipulator by the US Treasury Department. That said, under a competitive agreement that was put in place in 1998, the US Treasury Department can pick out one of those three aspects under a qualitative measure if it's significant enough. And I think that trade surplus that we've been seeing there that China runs with the US is enough perhaps for them to label China a currency manipulator. So in theory, China is not a currency manipulator, but because we've seen Donald Trump and Mike Pence come out recently and suggest that they are, there's every possibility that the US Treasury will class China as the currency manipulator, even though I don't believe that's going to be the case. And I think if that's the situation, that will just deteriorate relationships between the US and China even more. So I think we have to watch out for that. The three questions that the US Treasury Department do question, China is not a manipulator, but there are ways and means around that for them to do. And I think that could be a big impact in that relationship that we are watching out for. And that could have big implications on global investing and also certainly the Australian dollar.